Another important layer to understand is how financial contagion works in a modern, highly connected economy. In the past, a crisis might have been contained within one sector or one country for a longer period of time. Today, markets are globally intertwined. A banking issue in one region can ripple across oceans within hours through currency markets, bond yields, and investor sentiment. This means shocks travel faster, reactions are more emotional, and recovery periods can become more uneven. When investors rush to safety all at once, liquidity dries up, and assets that were once considered stable can suddenly become volatile. Technology has also changed the speed of financial cycles. Algorithmic trading, high-frequency trading, and automated risk models can amplify market moves. When prices fall below certain thresholds, machines sell instantly, often without considering long-term value. This creates sharp, sudden drops that feel disconnected from economic reality, but still cause real damage to portfolios and confidence. These rapid declines can turn a manageable correction into a panic-driven sell-off, especially when combined with negative news headlines and social media speculation. Another often overlooked factor is the labor market illusion. Strong employment numbers can give the impression that the economy is healthy, even while underlying conditions weaken. Employers may delay layoffs, hoping for a recovery, while profits quietly shrink. Eventually, cost-cutting begins and layoffs accelerate rapidly rather than gradually. Historically, job losses tend to rise sharply once they start, which further reduces consumer spending and reinforces economic slowdown. This lag effect can catch households off guard, especially those living paycheck to paycheck. Corporate earnings also deserve close attention. During late-stage economic cycles, companies often maintain profits through cost-cutting, stock buybacks, and financial engineering rather than genuine growth. This can temporarily boost stock prices, but it also reduces resilience. When revenue declines, there is less flexibility to absorb shocks. Investors who only look at surface-level earnings may miss the deeper weakness forming beneath the numbers. Over time, reality asserts itself, and valuations adjust accordingly. There is also the issue of commercial real estate, which rarely gets the same attention as residential housing, but plays a massive role in the financial system. Office buildings, retail spaces, and multifamily housing rely heavily on debt financing. Changes in work habits, online shopping, and interest rates have placed pressure on property values and refinancing options. When large loans come due in a higher rate environment, refinancing becomes difficult. This can strain banks, investors, and pension funds that are exposed to these assets. Small and regional banks, in particular, can become vulnerable during these periods. Unlike large institutions, they often lack diversified income streams and rely more heavily on local lending. If defaults rise or asset values fall, confidence can erode quickly. Even healthy banks can suffer when fear spreads, as depositors move funds elsewhere. Banking stress does not always require widespread insolvency. Sometimes it only requires a loss of trust. Another signal worth watching is government response behavior. When policymakers begin discussing emergency measures, stimulus programs, or regulatory changes preemptively, it often indicates underlying concern. While these actions are meant to stabilize the system, they can also distort markets and delay necessary adjustments. Over time, repeated interventions reduce the effectiveness of future responses, leaving fewer tools available when conditions worsen. For individual investors and households, the biggest risk is not the crisis itself, but poor decision-making during uncertainty. Chasing returns late in cycles, ignoring risk management, or assuming past performance guarantees future results can lead to painful outcomes. Financial history repeatedly shows that discipline matters more than prediction. Those who focus on cash flow, balance sheets, and long-term objectives tend to navigate turbulent periods with less stress and fewer irreversible mistakes. It is also important to recognize that crises create asymmetrical outcomes. While some people lose ground, others gain opportunities. Businesses with strong balance sheets can acquire assets at discounted prices. Long-term investors with liquidity can enter markets when fear dominates. This is why preparation is not just about defense, it is also about positioning. The difference between damage and opportunity often comes down to readiness before conditions deteriorate. Behavioral psychology plays a powerful role in these moments. Fear and greed do not disappear simply because people are aware of them. Even experienced investors feel emotional pressure when markets swing violently. This is why having predefined rules, asset allocation strategies, and risk limits matters. Decisions made in advance tend to be far better than decisions made in the heat of the moment. Another dynamic to consider is generational exposure. Younger investors may have never experienced a prolonged downturn, while older investors may underestimate how different the next crisis could look compared to previous ones. Each financial disruption has unique triggers, even if the patterns rhyme. Assuming that the future will mirror the past can be just as dangerous as ignoring history altogether. Currency stability is another subtle but powerful factor. When confidence in monetary policy weakens, currencies can fluctuate sharply. This affects import prices, corporate margins, and consumer purchasing power. While the US dollar remains dominant globally, no currency is immune to pressure. Shifts in global capital flows can change conditions, quickly influencing inflation, interest rates, and asset prices at home. Ultimately, financial systems are built on confidence. Confidence in money institutions and expectations about tomorrow. When that confidence is strong, economies expand. When it weakens, contraction follows. Understanding this cycle helps explain why warning signs matter long before headlines turn negative. The goal is not to predict exact dates or triggers, but to recognize vulnerability when stability feels most comfortable. One more element that deserves serious attention is the role of household expectations. When people believe tomorrow will be better than today, they spend, invest, and take risks. When that belief starts to fade, behavior changes quietly at first. Families delay big purchases, reduce travel, postpone home upgrades, and become cautious with credit. These small decisions don't make headlines, but collectively they slow economic momentum. By the time the data confirms it, the slowdown is already well underway. Media narratives also influence financial stability more than most people realize. During late cycle periods, optimistic stories dominate: new technologies, record-breaking markets, and resilient consumers. While some of these narratives are true, they can create a false sense of security. When the tone suddenly shifts negative, the psychological impact is severe. Markets often react not just to bad news, but to the change in narrative itself. Confidence can evaporate faster than it was built. Another risk factor lies in retirement systems. Millions of Americans depend on 401s, IRAs, and pension funds that are heavily invested in financial markets. When asset prices fall sharply, retirement timelines can change overnight. This can force older workers to delay retirement or re-enter the workforce, while younger workers may feel discouraged about long-term saving. These shifts affect labor supply, consumer behavior, and overall economic confidence, reinforcing the cycle of stress. Corporate debt refinancing is another area where pressure quietly builds. Many companies borrowed aggressively during periods of low interest rates. As those loans mature, refinancing at higher rates squeezes cash flow. Some businesses can absorb the cost, but others cannot. When margins are already thin, higher interest expenses can turn profitable companies into distressed ones. Layoffs, asset sales, and bankruptcies often follow, even if demand remains relatively stable. Global geopolitics also plays a subtle but powerful role in financial stability. Trade tensions, regional conflicts, and supply chain disruptions introduce uncertainty into corporate planning and investment decisions. Companies hesitate to expand, hire, or invest when geopolitical risks increase. Capital tends to flow toward perceived safety, which can distort markets and amplify volatility. These risks are difficult to quantify, but their impact becomes clear when confidence breaks. There is also the question of market complacency. Long periods without major disruptions can lull investors into assuming stability is the norm. Risk premiums shrink, leverage increases, and protective strategies are abandoned because they seem unnecessary. This complacency is often visible in volatility measures staying unusually low, even as underlying risks grow. When volatility finally returns, it tends to do so violently. Another aspect often misunderstood is that crises don't require a single massive failure. Sometimes they emerge from a series of small stresses that interact unexpectedly. A few corporate defaults, a modest decline in housing prices, slightly tighter credit conditions, and cautious consumers may seem manageable individually. Together, they can form a self-reinforcing loop that accelerates economic contraction. By the time the pattern becomes obvious, reversing it becomes much harder. Financial innovation, while beneficial, can also introduce hidden risks. Complex financial products, derivatives, and structured investments often promise efficiency in returns, but they can obscure true exposure. During stable periods, these instruments perform as expected. During stress, correlations rise, liquidity disappears, and risks that were assumed to be diversified suddenly converge. This was a major lesson from past crises and remains relevant today. Another issue is the growing gap between asset owners and wage earners. When asset prices rise faster than wages, inequality increases. This creates social and economic tension, which can influence policy decisions. Sudden regulatory changes, tax adjustments, or interventionist policies introduced during times of stress can add another layer of uncertainty. Markets must then price not only economic risk, but political and regulatory risk as well. Credit availability is another critical signal. When lenders tighten standards even slightly, the effects ripple outward. Businesses delay expansion, consumers reduce borrowing, and real estate activity slows. Credit contraction doesn't need to be extreme to cause damage. Even moderate tightening can significantly slow an economy that relies on borrowing to fuel growth. Watching lending behavior often reveals stress before markets fully react. Investor time horizons also shorten during uncertain periods. Long-term strategies give way to short-term thinking. This increases market noise and reduces price stability. Frequent trading, reactive positioning, and headline-driven decisions amplify volatility. The result is an environment where prices move more on sentiment than fundamentals, increasing the likelihood of sharp corrections. It's also important to acknowledge that not all pain is evenly distributed. Certain sectors tend to feel stress earlier than others. Cyclical industries, small businesses, and heavily leveraged companies are often the first to struggle. Defensive sectors may appear stable longer, creating a misleading sense that the broader economy is fine. By the time stress reaches more stable areas, momentum has already shifted, demographic trends add another layer of complexity. An aging population affects labor supply, healthcare costs, and savings behavior. Younger generations face different challenges, including higher education costs and housing affordability. These structural factors don't cause crises on their own, but they shape how resilient an economy is when shocks occur. Lower resilience means smaller shocks can have larger consequences. Psychologically, humans are wired to extrapolate recent experiences into the future. After years of market gains, it feels natural to expect more of the same. This bias is powerful and difficult to overcome. Recognizing it doesn't eliminate it, but awareness can reduce its influence. Financial discipline often means acting in ways that feel uncomfortable in the moment, such as being cautious during optimism and calm during fear. Ultimately, economic systems are complex and adaptive. They don't fail in simple, linear ways. Stress accumulates, shifts locations, and sometimes disappears temporarily before resurfacing elsewhere. This is why warning signs are often debated and dismissed, but complexity does not mean randomness. Patterns exist, and history offers a framework for understanding them. Paying attention to these patterns is not about predicting disaster. It is about recognizing vulnerability before it becomes unavoidable. Another factor that often gets underestimated is how quickly confidence can reverse once a tipping point is reached. Confidence builds slowly but collapses rapidly. A single unexpected event, a major corporate failure, a sudden spike in unemployment, or a sharp move in interest rates can change perception overnight. What looked like isolated problems suddenly feel systemic. At that moment, behavior shifts from rational evaluation to collective self-protection, and markets begin to move faster than fundamentals alone would justify. Social dynamics amplify this effect. In today's environment, information spreads instantly. News, opinions, and speculation circulate through social media, financial apps, and 24-hour news cycles. While access to information has improved, so has the spread of misinformation and emotional reactions. Fear becomes contagious. When people see others pulling back, they instinctively do the same, reinforcing the cycle. This behavioral feedback loop can turn uncertainty into instability very quickly. Liquidity, which seems abundant during calm periods, can vanish when it is needed most. Assets that trade easily in normal conditions may become difficult to sell without steep discounts. This creates a gap between perceived value and actual market price. Investors who assume they could exit positions easily discover that liquidity is not guaranteed. This is particularly dangerous for leveraged positions, where forced selling can accelerate losses. Another subtle warning sign appears in corporate guidance. When companies begin offering cautious or vague outlooks rather than confident projections, it often reflects internal uncertainty. Management teams tend to see changes in demand, costs, and financing conditions before investors do. A broad shift toward conservative guidance can signal that business conditions are becoming less predictable, even if headline earnings still appear strong. The role of consumer credit cannot be ignored. When borrowing shifts from investment and long-term planning toward covering everyday expenses, it indicates stress beneath the surface. Rising delinquency rates, even if modest at first, often precede broader financial strain. Credit acts as a bridge between income and consumption, but when that bridge becomes overloaded, it weakens the entire structure of the economy. Another area of vulnerability lies in state and local government finances. Unlike the federal government, these entities have limited ability to absorb prolonged revenue declines. Falling tax revenues combined with rising expenses can force spending cuts, layoffs, or increased borrowing. These actions affect public services, employment, and regional economic activity, adding another layer of pressure during downturns. Investor narratives also tend to simplify complex realities. Phrases like soft landing, or temporary slowdown, or contained risk can be comforting, but they may obscure deeper structural issues. While optimism has its place, excessive reliance on reassuring narratives can delay necessary adjustments. When reality finally challenges these stories, the adjustment can be abrupt rather than gradual. The housing market remains a psychologically important indicator. Even when it is not the epicenter of a crisis, changes in housing activity influence consumer confidence and spending. Slowing sales, declining affordability, or rising foreclosures can affect how people perceive their own financial stability. Since homes are the largest asset for many households, shifts in housing values carry emotional weight as well as financial impact. Energy and commodity markets also play a role in financial stability. Price spikes can act like a tax on consumers and businesses, reducing disposable income and profit margins. Conversely, sharp price drops can signal weakening demand and stress in producing regions. Volatility in these markets often reflects broader economic uncertainty rather than isolated supply issues. Another important consideration is the behavior of institutional investors. Pension funds, insurance companies, and large asset managers must meet long-term obligations. When markets become volatile, these institutions may rebalance or reduce risk exposure to protect solvency. Their actions can move markets significantly due to the sheer scale of their holdings. What looks like a sudden market move may actually be a structural adjustment driven by long-term constraints. Financial stress also affects entrepreneurship and innovation. In uncertain environments, access to capital becomes more selective. Startups and small businesses, which often drive job creation and innovation, may struggle to secure funding. This slows economic dynamism and reduces future growth potential, even if larger firms remain relatively stable for a time. Another psychological pattern worth noting is hindsight bias. After a crisis, warning signs seem obvious, and people wonder how they were missed. Before a crisis, the same signals are often dismissed as noise or false alarms. This bias makes it difficult to act decisively in real time. Understanding this tendency can help individuals remain more open to uncomfortable information rather than rejecting it outright. Market correlations also tend to rise during stress. Assets that normally move independently begin to move together. Diversification that worked well during calm periods may provide less protection when it is most needed. This does not mean diversification fails entirely, but it highlights the importance of understanding underlying risk factors rather than relying solely on historical correlations. There is also the challenge of policy lag. Economic data reflects past conditions, not current ones. By the time official indicators confirm a slowdown, conditions may have already changed significantly. Policymakers respond based on this delayed information, which can result in actions that arrive too late or overshoot their target. This lag complicates efforts to stabilize the economy during rapidly evolving situations. Another overlooked issue is corporate concentration. As industries consolidate, a smaller number of large firms hold greater influence over employment, supply chains, and market behavior. While this can increase efficiency during growth periods, it can also increase systemic risk. Problems within a few dominant players can have outsized effects across the economy. Finally, it is important to recognize that financial systems are not separate from human behavior. Numbers, charts, and models are useful tools, but they cannot fully capture fear, confidence, and expectations. These intangible factors often drive outcomes more powerfully than data alone. Understanding this human element helps explain why crises feel sudden and overwhelming, even though the underlying pressures have been building quietly over time. As we bring this conversation to a close, the most important message to understand is this: financial crises are not random accidents. They are the result of ignored signals, delayed decisions, and misplaced confidence. The warning signs rarely appear all at once, and they almost never look dramatic in the beginning. They emerge quietly through rising stress, growing imbalances, and subtle shifts in behavior that most people dismiss as temporary or normal. The difference between those who suffer most in a financial crisis and those who endure or even emerge stronger is not luck or insider knowledge. It is awareness, preparation, and discipline. You do not need to predict the exact moment or cause of the next crisis to protect yourself. You need to recognize that uncertainty is part of the system and plan accordingly. Stability should never be assumed, especially when everything appears calm. History has shown us again and again that confidence can vanish faster than it is built, liquidity can disappear when it is needed most, and markets can reprice risk with shocking speed. But history also shows something else that is equally important. Every crisis eventually creates opportunity. Opportunity for those who preserved capital, avoided reckless decisions, and remained patient when others panicked. The goal is not fear. The goal is resilience. Financial resilience means having flexibility, clarity, and control over your decisions when conditions change. It means understanding that real security comes not from chasing maximum returns, but from managing risk, staying informed, and thinking long-term in a short-term world.